Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Evolv Technologies Holdings Inc. Annual Report. Evolv Technologies Holdings Inc. offers a range of security screening products and services to various industries worldwide. The company's flagship product, Evolv Express, detects firearms, improvised explosive devices, and large tactical knives in unstructured people flows. In addition to Evolv Express, the company provides Evolv Expedite, an autonomous AI-based weapon detection system designed for high-clutter environments. This system is specifically tailored for detecting weapons in bags being brought to venues by visitors. Evolv Technologies also offers the Insights Analytics application, which provides self-serve access to insights on visitor flow and arrival curves, location-specific performance, system detection performance, alarm statistics, and comparisons across multiple business dimensions. The company serves a diverse range of industries, including education, healthcare, professional sports, performing arts and entertainment venues, government offices, corporate offices, hospitality facilities, distribution centers, large industrial workplaces, and houses of worship. Evolv Technologies Holdings, Inc.'s stock price has skyrocketed in the past year due to a combination of strong financial results and strategic advancements. One key factor is the company's robust fourth quarter 2025 earnings, which exceeded revenue expectations with $38.5 million, marking a 32% increase year-over-year. This was accompanied by a net income of $10.9 million in Q4 2025, a significant improvement from the prior year. The company has also seen significant growth in its annual recurring revenue, ARR, which grew by 21% year-over-year to reach $120.5 million by the end of Q4 2025. Furthermore, Evolv Technologies raised its revenue guidance for 2026 to $172-$178 million, and projected ending ARR for 2026 to increase to $145-$150 million. The company's shift towards a pure subscription model is also expected to generate more predictable and higher quality recurring revenue, further bolstering its financial stability. Additionally, Evolv Technology has seen strong new customer acquisitions and expansion of deployments within its existing customer base, with the company screening over 4 billion people worldwide since 2019. Analysts have shown increasing optimism regarding the company's earnings prospects, leading to higher EPS estimates and contributing to a positive outlook for the stock. The company has also secured strategic partnerships and deployments in various sectors, including sports and entertainment, education, and healthcare. Overall, these factors have contributed to Evolv Technologies Holdings, Inc.'s substantial stock price increase of 66.14% to 60.25% in the last year. Evolv Technologies Holdings, Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Evolv Technologies Holdings, Inc. trades at a higher price-to-book ratio of 7.71 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for Evolv Technologies, Inc. are multifaceted. One key driver is the increasing demand for its products and services, particularly for the Evolv Express and Evolv Expedite equipment and related add-on accessories. This growing demand has led to a significant increase in revenue from these sources. Another major driver of revenue growth is the shift towards subscription-based SaaS, software as a service, and maintenance revenue. The company's 4-year arrangement with customers allows for allocation of transaction price based on relative SSB, resulting in steady and predictable revenue streams. Additionally, the discontinuation of the distributor license model for new unit sales has also contributed to revenue growth. The effectiveness of the channel partner rebate program is another significant driver of revenue growth. By incentivizing resellers to meet targets, the company has been able to increase professional services revenue from its reseller partners. This program has not only driven revenue growth, but also strengthened relationships with key partners. In contrast, the primary drivers of revenue decline are largely related to accounting and contractual issues. The inappropriate recognition of revenue due to extra-contractual terms and conditions in sales agreements has led to a decline in revenue. Additionally, the cancellation of contracts by customers has resulted in immaterial amounts being returned to customers, further contributing to revenue decline. Overall, Evolv Technologies' revenue growth is driven by increasing demand for its products and services, subscription-based SaaS and maintenance revenue, shift to purchase subscription model, and effectiveness of the channel partner rebate program. Conversely, revenue decline is primarily due to accounting and contractual issues. The net income of the company experienced a slight improvement in 2025 compared to 2024. Despite decreasing from a net loss of $54 million to a net loss of $33.1 million, this represents an improvement of $20.9 million. However, the company still incurred a net loss. A closer look at the profit margins reveals a more significant improvement. The gross profit margin for product revenue increased by 54% from -66% in 2024 to -12% in 2025. This is largely due to an improvement in adjusted EBITDA of $32.1 million year-over-year. The reasons behind these changes are multifaceted. Material weaknesses in internal control over financial reporting and a lack of profitability historically have contributed to the company's struggles. Additionally, increased costs from expansion into new markets and product offerings have not been sufficiently offset by revenue growth. Unforeseen operating expenses, difficulties, complications, delays, and other unknown factors have also played a role in the company's net income decline. The company's financial performance has shown a significant improvement in terms of operating cash flow. In contrast to the previous year, where it was reported that the company generated negative operating cash flow, the latest data indicates a shift towards a more stable and profitable position. The operating activities resulted in a substantial cash inflow of $18.7 million for the year ended December 31, 2025. This positive trend is further reinforced by the net cash provided by operating activities, which stood at $18,669 in 2025, marking a stark contrast to the negative figure of -$30,853 recorded in 2024. Overall, it is clear that the company has successfully transitioned from generating negative operating cash flow to achieving positive results, indicating a more stable financial foundation. The company's financial situation has undergone significant changes in terms of its debt level and interest expenses. According to the extracted summaries, the company's long-term debt has increased substantially from $0 in 2024 to $28,596 in 2025. This increase is further supported by the total debt level of $30 million under the initial term loan drawn and outstanding. However, when it comes to interest expenses, the picture is more complex. While some pages report a significant decrease in interest expense from -$2,942 in 2024 to $196 in 2025, others indicate an increase in total interest expenses and non-cash interest expense. Specifically, there are reports of an increase in interest expense by $1.7 million in 2025 compared to the previous year. Despite these conflicting reports, it is clear that both debt level and interest expenses have undergone significant changes. The company's increased debt level is a notable development, while the fluctuations in interest expenses suggest a need for closer examination of its financial management practices. The performance of various segments and regions in the market has been a subject of concern for many companies. One area that has shown poor performance is international markets. These markets have limited growth potential, are plagued by regulatory and compliance risks and face uncertainty in terms of market acceptance. The differences in security threats, customer perceptions, and regulatory environments across these markets further hinder their growth. On the other hand, some segments and regions have not been evaluated for their performance metrics. The United States is one such region that has not been assessed, nor have foreign markets, vertical industry markets, or sales models like pure subscription, purchase subscription, and distributor licensing. These areas remain unexamined in terms of their performance, leaving room for further analysis and evaluation. Management's outlook for the company is optimistic, driven by its mission to make the world a safer place. Key drivers of this optimism include expected revenue growth due to increased adoption of touchless security screening technology and expanding customer deployments. The company is shifting towards a subscription-based model, focusing on recurring commercial sales. To support growth, management is investing in various areas, including product innovation, sales and marketing efforts, and channel partnerships. This investment is expected to be sufficient to fund operating expenses and capital expenditures for at least 12 months, thanks to the company's cash reserves. Despite geopolitical and macroeconomic uncertainty, management remains committed to long-term goals. The company has also taken steps to mitigate supply chain risks through a non-exclusive agreement with Plexus Corp. Additionally, employee equity incentives are being granted to certain employees, subject to vesting conditions based on stock price appreciation and continued service. Overall, management's focus is on driving revenue growth, investing in growth initiatives, and managing cash flow while navigating uncertainty. The company has made several strategic moves through acquisitions and divestitures in recent years. On the acquisition front, the company entered into a non-exclusive contract manufacturing agreement with Plexus Corp. In November 2025. Additionally, it signed a distribution and license agreement with Columbia Tech in March 2023, although financial details were not disclosed. The company also underwent a merger with NHIC Special Purpose Acquisition Company, which involved assuming warrants for 14,325,000 shares of common stock. Furthermore, it merged with Legacy Evolv, issuing 15 million earnout shares to its shareholders and service providers subject to certain conditions. In terms of divestitures, the company discontinued quoting on the distributor licensing model with Columbia Tech effective September 30, 2025. The agreement with Columbia Tech also expired on December 31, 2025. Moreover, the company contributed 517,500 founder shares to give Evolv LLC. These strategic moves reflect the company's efforts to adapt and grow in a rapidly changing market. The company's financial strategy has been focused on retaining earnings rather than distributing them to shareholders in the form of dividends. According to the annual reports for both 2024 and 2025, no cash dividends have been declared or paid as of December 31st of each year. This suggests that the company is prioritizing reinvestment in its business operations over dividend payments to shareholders. Concerns about inventory buildup and supply chain disruption are evident throughout the extracted summaries. On page 13, it is noted that increases in component costs, long lead times, and supply shortages could disrupt the supply chain. Similarly, on page 17, potential delays in production due to contract manufacturers' inability to manage their supply chains are highlighted. The uncertainty surrounding tariffs and trade restrictions, page 18, also poses a risk to imports and exports, further exacerbating concerns about inventory buildup and supply chain disruption. Additionally, limited manufacturing capacity for certain components, page 45, and non-recurring inventory charges, page 48, contribute to these worries. However, it is worth noting that there are instances where no concerns about inventory buildup or supply chain disruption are mentioned, pages 9, 25, 49, 54, 58, 85, and 87. Nevertheless, the overall tone of the summaries suggests that there are legitimate concerns about inventory buildup and supply chain disruption. That concludes the financial summary for Evolv Technologies Holdings Inc. Feel free to comment below, and I will be happy to answer them when possible.